Welcome everyone to this week's edition of the Commercial Real Estate 101 Meetup Group. For those of you guys who are tuning in for the first time, we actually started this group back in 2020, and ever since then we've been inviting speakers to talk about a variety of different topics pertaining to commercial real estate. And today we have the honor of interviewing Ashley Tison. You're actually the CEO of OZPros, and this is going to be a discussion on opportunity zones. It's probably something that a lot of people have heard about, but up until recently, I must admit I didn't know much about it myself. So I'm looking forward to having the conversation, and welcome to the show, man.
Yeah, well, appreciate you having me on. It's an honor and a privilege. Kudos to you for doing it via StreamYard. Man, I love StreamYard. Like, as we've started kind of utilizing it and implementing it, it just makes such a big difference. And sometimes it freaks people out going live. It's like, hey, man, it just cuts down on so much post-production stuff. So awesome stuff. Pleasure to be here today. Super stoked to talk about opportunity zones and other tax mitigation strategies that we've been helping people save money on taxes with.
Absolutely. Well, and I'm looking forward to the discussion. And I know offline we'd obviously connected. The reason I saw you was because you were interviewed by Tyler Cobble, a developer out of Nashville. And you get such a great job on his podcast. I thought that our audience could really benefit from learning a little bit more about this particular opportunity. So
I should have rolled my cowboy hat again, right?
You should have, man. Yeah, I know. Well, you're actually, if I'm not mistaken, are you located in Ohio?
No, I'm in Charlotte, North Carolina.
Charlotte, North Carolina. Okay, sorry. So, but again, again, it's not too far away, and but I'm excited to kind of dive into the topic. So, as far as the actual conversation points for today, our show is typically structured to focus on one particular area of discussion for the entire podcast. And so today's episode is going to be focused on opportunity zones. So if you don't mind, could you tell us a little bit about your background, and then really why you decided to get into helping people set up these opportunity zones?
Sure. So I'm an attorney. I like to call myself a reformed attorney because I quit practicing because I wanted to get in the game. I actually sold my law practice back in 2017 so that I could focus on putting more money in entrepreneurs' pockets, because it's not about what you make, it's about what you keep. Before that, I had an M&A practice, and I helped business owners, kind of build value in their companies and then exit those. And we put together a system for streamlining that process of bringing kind of Wall Street level sophistication to Main Street America. And I've always had a passion around that. So I started out at a big firm, went to work for a tenant and common syndicator, and we sold stuff to Wall Street and through a broker dealer network and that kind of thing. But I've always kind of been drawn back to that Main Street level real estate play, where there's mom and pops that are doing deals and trying to get them access to some of the more sophisticated tricks and trade, of the trade, and allowing them to deploy that for themselves. And so I sold the practice, started a succession planning deal where we were trying to show people how to grow their companies and then exit them well, and then position the next generation for not mucking it up. And it is amazing how many people did not want to talk about succession planning and about their death. And so I heard about opportunity zones. It was at a CLE, and this guy was like, man, it was like, it's basically like 1031 and private equity got married. And I was like, man, that sounds like exactly in line with my background. And so I started kind of delving into opportunity zones, and I was like, hey, what if we take that system that we developed for M&A and we repurposed it for opportunity zones, and kind of became the legal Zoom for opportunity zones? And that's what we've done. We started it to where people could do it themselves, and it quickly became clear that that even though they could file the paperwork themselves, that they still needed the background knowledge relative to everything that's happening inside of OZs, because it's not that hard, but there are nuances to it that if you don't hit the nuances, then you blow the whole benefit of the program. And so we put together a system for doing that. We actually are doing that now for the Corporate Transparency Act as well. That's something that we should probably talk about at some point in time during the show. And we've set up over 500 qualified opportunity funds. We've had more than 3,500 strategic strategy calls with folks where we talk them through opportunity zones. And try to see if we can't help them, kind of live out their real estate dreams, but just do it in a tax deferred vehicle. Which is probably a good spot for me to talk about like what our opportunities
Yeah,
are
and that's
how they work, right?
to my point. That's the exact question that I was going to ask you next. If you could kind of describe what exactly do opportunity zones mean, because you described it somewhat being kind of a blend between the 1031 exchange and also the marriage of the real estate and private equity side. So if you could kind of explain what an opportunity zone is, that'd be great.
So, and I like visuals, so I don't know if you're okay with that, but
Sure.
Okay with that right there.
Yeah.
Can you see that? So
let's see if I can share. I may be able to put it so that
it's
you're
big.
the primary. Yeah,
There we go. Look at that. So this is an opportunity zone map. If you want to pull up an address to see if it's in an opportunity zone, you can go to ozpros.com/map and you can pull this up. But as you can tell, effectively the legislation allowed each governor to designate up to 25% of its low-income census tracts as opportunity zones. And so it's driven by census tract. And so you could tell that out west, those census tracts are bigger because there's fewer people consolidated and condensed. Out east, they're a lot smaller. And so there's 8,730 or 63 of these things. And they are all over the United States. And 98% of the island of Puerto Rico is an opportunity zone. There are some in the U.S. Virgin Islands. And then there's also, we've got them in Hawaii, Alaska, and Guam. And so these zones got designated by the governors. And if you have qualified capital gains and you put that money into so this is opportunity zones on a page. I like to call it the opportunity zone cheat sheet. And the key thing is that you got to start with a capital gain. And you got to put that capital gain into a qualified opportunity fund within 180 days of having the gain. Now, if it's through an S Corp or a partnership, then you've got 180 days from the partnership tax filing deadline. So we can go back to gains that occurred January of 2023 and pull those into a qualified opportunity fund. And the first benefit that you get when you put your money into a qualified opportunity fund is that you get to defer the taxes on that gain until December 31st, 2026. The second benefit was that you got to pay a little bit less taxes when you go to pay those taxes in 2026. But this is the big one, is this permanent exclusion in the form of a step up in basis to fair market value. And for those, and just to kind of explain this really fast, capital gains is computed based upon what you paid for it, that's your basis, and what you put more money into it, that's also your basis, versus what you sell it for, which is the fair market value. And whatever the difference is, that's how you pay capital gains on it. And then if you've bonus depreciated it and you sell it before you've caught up on the schedule for that bonus depreciation, you also pay this thing called depreciation recapture, because they're not going to let you cheat and basically get out of paying income taxes and then sell it and then not have to pay those. And so what opportunity zones do is that it eliminates both of those. It eliminates capital gains and the depreciation recapture on whatever your new investment is. So a qualified opportunity fund, that's going to be daunting to some people because they're like, oh, wow, what is actually a qualified opportunity fund? Is that some like gigantic fund that's like Caliber or something like that? And the answer is no. A QOF can simply be an LLC taxed as a partnership. So 90% of the ones that we've set up are literally, they are bespoke captive opportunity funds that people have their own capital gain and they want to do their own project. So we set them up a QOF, which is an LLC taxed as a partnership. And then we usually set up a QOZB, a qualified opportunity zone business. They drop the money from the QOF to the QOZB, and then they go buy real estate. But here's the thing, and this is the reason why 1031 and private equity got married, is that this QOZB doesn't have to just own real estate. It could be an operating business. And as long as it meets these 5 tests, you can have that qualified opportunity zone business be your investment. And all you have to do is either you can lease property inside of a zone and just have your employees located in a zone. And now if you were to start the next Facebook and it was to go from, $500 to, let's say it's $500 million, you're going to pay 0 taxes on the growth of this to the 500 million. So in that operating business space, that's where these, where you've got a huge potential for tax benefit. It also is a great potential for tax benefit for anybody that's doing a real estate deal, because if you're doing a real estate deal that's, $300,000, in 10 years, you're expecting it to at least double in value. And so you're going to pay taxes on that $300,000 increase. With opportunity zones, it wipes that out. And so people ask me all that time, what kind of the minimum size deal? And if you really work the numbers on how much it costs to kind of maintain it and do compliance and that kind of stuff, it's about $300,000 that you're going to want to have in in gain, or like as a project. The other thing is that you don't have to have it all in gain. So on a $300,000 project, if you roughly had $30,000 in gain, then bam, you put your $30,000 in, bring in debt, and now all of it's coming out tax-free on the back end.
Yeah, and that's a super powerful strategy, as you kind of explained. So just to provide some color and context to what we just described, because you did share a bunch of information, I think it'd be kind of helpful to walk through somewhat of a scenario about how this could potentially operate. So to your point, there are opportunity zone areas across the country. And if you go to the map that, OZPros provides, you'll kind of see, areas of your municipality that you're located in that could qualify as opportunity or opportunity zones. And you'll be kind of surprised. I mean, sometimes I go to the map and I look and I'm like, there's no way that this would be considered an opportunity zone because it's one of the hotter parts of town. But maybe when they drew the map at the time, maybe it wasn't quite there yet. So
it was based on the 2010 census. And so a lot of stuff has changed since then.
Oh, yeah. Yeah, that's almost 15 years now, which is crazy to think, but exactly right. So, we've got an area of town, several areas of town that fall under opportunity zones that are now like kind of the hot spots to develop. And so if you were to acquire property in that area, obviously it's a benefit because you're seeing a rapid appreciation of properties in that vicinity because there's a lot of money moving into that area. And as long as you hold it for that 10-year period, you could benefit from the capital gain, the capital gain benefit as well.
Goes away.
Zero, exactly. And another thing to your point on the operating business, just out of curiosity, kind of separate secondary, I can just share more so on my side. I do a lot in the retail space, so I've got a lot of clients that own franchises. I've got clients that own, all different types of operating businesses. So as long as the operating business qualifies for, based on those requirements that were shared, and for those of you guys who are listening, we'll go ahead and try to see if we include the qualifications in the description of the YouTube channel or podcast format that you're listening to. But as long as they qualify for that period of time, if that business operates in that opportunity zone for a 10-year period, if you were to sell that business in 10 years, that also essentially receives the same treatment as you would otherwise. And does that translate to more franchises as well? So like, let's say that I'm a fast casual franchisee of a national firm. Does that also kind of translate? Or
yeah, franchises are easy because, usually you're going to have all of your employees coming to the same location. And so you got 5 tests as a QOZB. First is that 70% of your property needs to be qualified opportunities on property. And that means that it's either new or that you substantially improved it. And if you're leasing, there's no requirement. So if you lease a space, like as a franchisee, you probably would, then you're good to go. Then your second test is that 50% of your gross income needs to come from a trade or business inside of the opportunity zone. And that's measured by where your employees actually work. And so if you've got at least 50% of the hours being worked inside of the zone, then you're fine. Even if you were like a lawn cutting franchise, as long as they come back to the zone on a regular basis, we can usually make it work. And then your third test is that you got to use your intangible property, like your intellectual property, in the trade or business in the zone. They don't want people setting up patent trolls as QOZBs. And then your fourth is that you can't have more than 5% non-qualified financial property, which is cash, stocks, bonds, that kind of thing. So you couldn't set up like a bond trading company in a zone and then get out of paying taxes on all of the stocks that you were able to buy. And then the fifth one is you can't be a sin business. And that's a golf course, massage parlor, tanning salon, hot tub facility, or gambling facility, or if you sell off-premises alcohol. And so a franchise that's doing food or that's doing pretty much anything else, that's absolutely doable. What we've actually been able to do as well for franchisors is that we've been able to set up the franchisor as a QOZB. And then even if they have corporate owned stores, we set them up kind of parallel ownership structure to where the ones that are in opportunity zones, we put those in their fund. And then the ones that are outside, we put them in a separate entity. And then that separate entity pays the franchise fee over to the one in the opportunity zone. And when they exit that franchise 10 years out, they pay zero taxes on all of the goodwill associated with the franchise.
Yeah. And that's extremely powerful. And that could be something that, again, I think that's why it's so important to have this conversation, because, I can use myself as an example. I was completely unaware that there's an operating business component as well to the OZ fund. And obviously us as professionals, and just to give you some color to the people that listen to the podcast, we have a very big contingent of people that represent our landlords, obviously a bunch of commercial brokers, commercial investors as well. And a lot of them are representing either entrepreneurs, business owners. They themselves are obviously business owners and investors as well. So having this as an option to kind of keep in your toolkit can be extremely powerful. And although, as you mentioned before, the capital gain deferment for the initial period of until 2026, before, when the program was instantiated, or I don't know exactly when it was established, but one of the big 2018. So since then, I know there was incentives to try to reduce the amount of capital gains paid if you held it in that fund for a period of time. I know that's kind of winded down a little bit. But that went
away in 2019 and 2021. What they were trying to do is to get people off the sidelines, and it worked.
Yeah.
And so they introduced these deadlines with these expiring incentives. There's legislation that's pending right now that'll probably bring those incentives back. We're probably not going to see action on that till after the election, but I think it's realistic that it gets passed prior to the expiration, where we see those deadlines get extended and a rejuvenation of the program. Because we've seen over $150 billion worth of private capital come into these opportunity zones as a result. And there's no other program that's seen that kind of participation. So they're going to do something with it. It's just a question of what.
Yeah, 100%. And we'll dive into that a little bit later about what you see the future of the program looking like. But I guess one thing that I was curious about is, describing the process. So let's say, I'm Mr. Business owner, franchisor, or even franchisee, and I say, okay, Ashley, I want to pursue the process of setting up the fund so that I can benefit from this process over the 10-year period. I guess, what is the process of setting all this stuff up, and then obviously the ongoing responsibility of making sure that you're compliant over that period of time?
Sure. So, I mean, it's literally 10 days, and we've got a questionnaire that we need you to answer, and we'll do an intake call based upon that questionnaire. And then we get your fund and your QOZB set up in 10 days. We do all of the ancillary documents, and we show you how to move your money from your capital gain into the fund and then down to the QOZB, and with all the contribution agreements and that kind of thing, to make sure that it's done correctly. And then as part of our package, we have a weekly mastermind that's called Ascent. And so you get to come into that, and it's Tuesdays from 10 to 11:30, and I answer questions, and then also kind of bring in updates and things that are happening in the industry, of things that people need to be paying attention to. And we've got about 100 people in that mastermind, and they're regularly doing deals together and, kind of crossing over with different resources. So it's been actually really cool to see how that's happened. But that's how we make sure that you are doing things correctly going forward. Some people choose to do their own compliance out of that. And the greatest thing about this program is you don't have to ask for permission from anybody. You don't have to get permission from the IRS. You don't have to go to a CDFI. You don't have to go through a big process. All you have to do is just do it. But the key thing about that is you better have good records documenting what you've done. And so we walk people through this on a regular basis. We have a compliance checklist as part of our package. And then some people want to do it themselves, and we walk them through that. Some people want us to do it, and then that's an extra fee if they want our folks to kind of come in. We also have bookkeeping services that people can use if they want us to kind of do it from the inception, where it's like, hey, you guys just take care of all of that, and we can do that.
Yeah, that makes sense. And to your point regarding some of the nuances and maybe the pitfalls, I think that'd be kind of interesting to share, especially on the ongoing maintenance side, because granted, you can, like you said, set up the fund, it being an LLC taxed as a partnership. And out of curiosity, this is kind of a side note. Is there a reason why it can't be taxed as, let's say, an S corp or some other form of entity?
You could absolutely use an S corp or a C corp. I mean, usually you don't want to hold an appreciating asset in either an S corp or a C corp because you are capped on the benefit that you can get for the depreciation in the meantime. And then you usually have a double taxation issue when you try to go to take it out on the back end. Now, opportunity zones help shore that up a little bit, but it doesn't fully get there. And so the lion's share of ones that we set up are typically taxes partnerships. And then to the extent that somebody has a high income producing one, we'll usually set up a separate S corp as a management company that'll suck that profit off of it, and then they can utilize that to do kind of more creative things that that you may or may not be able to do as an opportunity fund. And so that's typically the way that we set it up. Some of the things that you got to be careful of is that in S corp, if you have an entity underneath it, a lot of times that's treated as a Q sub, and it's disregarded for IRS purposes. And we specifically need it to be regarded for IRS purposes because we need to show an entity underneath it in order to get qualified opportunity zone business status. Another nuance is inside of your record keeping, inside of your audit trail. And that's the key thing that you need is you need to go ahead and prepare. Hey, listen, I'm planning on being audited after 10 years when I go ahead and get this huge, massive tax benefit. And so I'm going to go ahead and build my audit book ahead of time. And I'm going to grab all of my bank statements. I'm going to grab all of the supporting documentation that supports the stance that I've taken. And a lot of times people don't do that. They have it generally in their stuff, but a lot of people just rely on the fact that the bank's going to hold their bank records or their statements. And, you get the statement type deal. And they're like, oh, well, I can keep it for 7 years. Well, the problem is that you need to keep it for 10 plus when you're doing an opportunity zone deal. So you want to make sure that you're grabbing all of that stuff in current year and then doing an analysis on it to see if there might be anything wonky. And then if there is, we can fix it in the current year, and we can usually document it with like a contemporaneous memorandum or some other kind of entry that year, as opposed to trying to go back and do this 10 years later when you can't remember and you can't find documents and that kind of thing. And so I think that that's probably the biggest nuance. And then you got nuances associated with like different operating companies or improvements to real estate or other types of things that need to, happen in order to get the benefit. And that's where we come in, and where you come in and you ask us questions on a weekly basis, and we make sure to get them answered.
Definitely. No, and I appreciate that because, again, to your point regarding the entity structure and kind of referring back to the being taxed as a partnership versus an S corp and C corp. Obviously in my own operating business, for example, I am taxed as an S corp because then I can take a small salary and then take distributions throughout the year such that I'm not having to pay the additional, I believe it's self-employment tax or whatever else. So I didn't know if that came in, comparing the tax savings for that versus being taxed as a kind of a general partnership. I didn't know if that was, if it made that much of a difference.
So you're definitely going to want to do exactly what you just described, but typically you're not going to want to hold the appreciating assets in that S corporation. And so what in my structure is I have a separate S corp that handles my high volume income.
Sure.
Right. So when I'm generating income, I generate it into that S corp, and then I can do like what you just described. I can also do I have a solo 401k because we don't have employees right now. You can do, other 401k packages and that kind of thing inside of an S corp, and you suck management fees off of your fund, your QOF and your QOZB to the extent that it's generating revenue. Suck those out into your S corp, and then it gives you flexibility to be able to do stuff outside of the zone where you're not like, hey, I got to actually go into the office inside of an opportunity zone as my S corp function. And doing it as a non-OZ deal allows you to deal with the income, but then to gain the appreciation for the stuff that you're doing inside of the zone.
Sure. Yeah. And that's a great point. And, again, this is the type of nuance that you help with, because again, I don't profess to be an expert in any of this stuff. And so, these types of questions are ones that I would be asking you if this were something that I were to be pursuing myself. And so, again,
Well,
that's
dude,
why
I thought we were setting up your fund on the
I know,
show
I
here.
know, or work. Yeah, right. Well, I appreciate that's what I'm saying. Like these are the type of questions that I genuinely have curiosity on, and I know that it's going to provide a lot of value to people
Sure.
on the show. So I guess one of the curious things that I could provide, maybe just to provide like an example of one, and I don't know if you can share specific details per se, but one
Sure.
you've set up relatively recently, and what were some of the results that they've achieved. And I know you've been in this for several years now, so and again, the 10 years have yet to expire on some of these funds to begin with, but as far as some of the benefits that they've achieved in a relatively short period of time, if you're willing to share an example of one, that would be awesome.
Sure. So we've actually got our own fund, and we've made some lead investments into some really cool stuff. So we bought a waterfront tiny house project down in Beaufort, South Carolina. It's in an opportunity zone, but it's literally got 3-mile marsh views. It was an old abandoned mobile home park that had turned into like a drug heaven.
Oh,
And
wow.
so cleaned out all the mobile homes, and then came back. It was grandfathered in as a manufactured home community. And so we're bringing back in really nice, like cabin style with porches and that kind of thing, cleaned it up so that all of the lots have a view of the water. We're putting in a dock, and, we're getting $2,000 a month on a 1-bedroom, 1-bath furnished apartment there for like traveling nurses and that kind of thing. We're
That's
actually
amazing.
going to be bringing in duplex mobile homes.
Mhm.
That's fascinating. I actually went and just got my manufactured home dealer's license because I'm so fired up about that product. And so we will have revenue that's coming off of that. And then we'll ultimately be able to sell that 10 years down the road. We're depreciating the mess out of the mobile homes along the way. We'll depreciate the dock that we're putting out there along the way. And then when we sell it 10 years out, we're going to not pay any capital gains tax on the appreciation of that waterfront property, not to mention the appreciation associated with the income stream that we've put out there. So that's one example. We also we bought a boat and RV storage facility down in an opportunity zone, and it had some covered spots, but the covered spots rent for literally 3x what the uncovered spots do. And so we created a brand called Covered Keeper, which we are now franchising, and we're doing that out of the opportunity zone. And so we're putting more covered spots there that have solar on the covered spots. We're transferring the tax credits associated with the solar as a way to offset the cost for us. And then we've got all the depreciation associated with the new carport, and then also with the solar that we put on there. And we're able to deliver that to our investors. And then when we go to sell it 10 years from now on that asset, and actually it's not how long you hold the asset, it's how long you hold the investment in the fund.
Mhm.
And so as we add these in, we started our fund back in 2021, starting in 2031. So in 7 years, we'll be able to start exiting these assets and not paying any capital gains or depreciation recapture on them. And, that's two examples that we are involved in that we really like. I mean, I've seen all kinds of stuff. I've seen bamboo farms. I've seen autism communities, like autism, almost like they're not hotels, but they're like dormitories, like where they're apartments and they got services in them. They're doing that as an opportunity zone deal. All kinds of multifamily hotels, mobile home parks, RV parks. I'm trying to think one of the vertical farming. We've seen a bunch of that, right? Where people are doing vertical farming in opportunity zones as part of kind of eliminating food deserts. And that's the really cool thing. So if you noticed in all of those examples that I gave, every single one of those is having positive community impact. There's like, even if it's just an RV park or a mobile home park, we turn something in from a slum into something that's really vibrant and that's resulting in jobs for the local folks in that opportunity zone. And so I think that that's one of the other things that you can't discount, and that it's really hard to put a price tag on it, because you're getting the tax mitigation benefit, but you're also able to do something really cool from a generational impact standpoint.
Yeah, and to your point, it creates the opportunity for people to invest dollars in areas that historically were just tough to make things work in because
Right.
either they were blighted or just the long-term appreciation of the investment may or may not be something that they were interested in pursuing because there's other opportunities out there that could potentially equate to a similar type of benefit. So
And
I
that's a good one because like people generally ask, they're like, well, what's the economics of this?
mhm.
And when you factor it in, and a lot of it depends on what your ultimate upside is going to be, because the higher that goes up, the more bump you get from being an opportunity zone. But
Mhm.
on a general deal, side by side, an opportunity zone deal is going to give you a 3% bump on IRR. So
Sure.
that's a 3% greater internal rate of return, which if you think about from a cap rate standpoint, if you're looking at a 5 versus an 8, that's real estate. And it's literally just because you did it in this area and you jumped through a couple of hoops. That's real estate investing nirvana.
Yeah. Well, 3% a year for 10 years. I mean, that's sizable. I mean, and especially when you start talking about, the amount of investment a lot of times you're investing in these funds, like
Correct.
it's not an insignificant number that would, come out of that. And so another thing that's kind of curious, you kind of alluded to some of the, tax credits that in that scenario where you're utilizing like solar credits and such like stuff like that. Are there opportunities to do, incentive stacking? So let's say, this opportunity fund or the opportunity zone is located in a historic tax district and
Yes.
I'm looking at a building and I say, okay, well, I'm going to do, try to renovate this building, get some historic tax credits. Maybe I'm also looking to do, a LIHTC deal, low income housing tax credit deal for a particular property. And it just so happens to be in the opportunity zone. Can you do it to where you stack some of those incentives on top of each other to kind of amplify your returns over time?
Absolutely. And we regularly help people deal with it. The easiest one is the solar play right now
Sure.
that the Inflation Reduction Act came through. The historic tax credit one it's doable, particularly if you can utilize it as the investor. If
Mhm.
you're trying to sell off the credit, it becomes a little bit more difficult because you typically have like a partnership flip structure. And you just got to be careful when you're doing that to make sure that you do it correctly. It's similar
Mhm.
with like a LIHTC deal,
Sure.
that your ownership structure is a little bit more complicated. But like a new market tax credit deal is a layup to do that, because most new market tax credit areas or most opportunity zones are eligible for new market tax credits as well. And so we've seen a lot of folks stack those.
Yeah, and I know there's like some green credits as well if you utilize like for the building material if you utilize certain green materials.
Correct. So there's the green and for putting multifamily assets online, there's a
Mm-hmm.
tax credit available for that. Yeah, and we've actually had some folks that have had success kind of selling off carbon credits as well.
Mm.
So they're putting in, farms that have high carbon sequestration value, and or they're, putting in pyrolysis, like energy processing plants, and they're grabbing the tax credits associated with that, but then they're also getting the carbon credits as a monetization of that as well. And we've actually done it where, and this would be interesting on the carbon credit play, is if we could get it to where that carbon credit comes in after year 10, you can make
Mm-hmm.
it so that you don't pay any taxes on that. Similarly, we had a wetlands mitigation bank that got set up, and we structured that to where that one's going to come in tax-free as well.
I mean, there's just so many different nuances and ways you can structure deals to be able to benefit
Really
from the
cool.
program. So it's really cool. And another thing that I'm really curious about on your side is you mentioned that it's based on when the funds that when the fund is set up
That's right.
for that 10-year period. So if you can clarify, just so I understand correctly, if you were to set up the fund today, but maybe you didn't fund or and maybe you
Yeah.
didn't have a project immediately, what's the impact of that, or how is that, you know, going
So
to be a benefit for you?
so 1031s require you to put, number one, you got to put your money with a QI.
Hmm.
Number two, you got to identify properties within 45 days. Number three, you got to close within 180. In an opportunity zone, you don't have to trace proceeds at all. You can pull money from somewhere else, just as long as you have a capital gain to line it up with. And so we use OZ deals to solve failed 1031s all the time.
Hmm.
The other component is is that when you're doing an OZ deal, as soon as you put your money into the fund, your 180 days is done. So you just got to get it into the fund within 180 days. And then once you have it in the fund, you have between 6 months and a year to drop it down to your qualified opportunity zone business. So you already got between 6 months and 12 months. Then once you put it down to your qualified opportunity zone business, you have 31 months to spend that money. So you've got between 37 and 43 months before you actually have to allocate it into property. Now, along the way, so as soon as you put your money into the fund, that starts your 10-year clock. So let's say that you use that full 4 years to get your project kind of up and running. Well, now you just have 6 more years until you have to, before you can exit it for the biggest tax benefit. The same is true if you were able to, so let's say that you fund your initial fund, and then 9 years down the road, you go and you buy a fix and flip house, right? Where you're buying it in an opportunity zone. You go in and you hit the substantial improvement threshold. You hold that thing for 377 days. And the 377th day, right? Because you need to hold it, well, it's 366 days or whatever it is in order to make it a capital asset. As soon as you hit that time frame, as long as that's past 10 years from when you initially put your money in the fund, you get to get a step up in basis to fair market value on that asset. So you could take that house, do a complete bonus depreciation cost segregation study on it, suck 40% out in tax benefit, sell it 366 days later, and then pay zero depreciation recapture and zero capital gains on the value increase. So it becomes the ultimate flip strategy vehicle. But the key is that you got to get your fund set up and you got to get it aging. And so that's what literally, even if people don't have deals, we're like, man, let's generate a gain. Let's get it aging right now. So that way you have it for when you do the deals.
Yeah, to that point. And another interesting point that you had just mentioned, which I think is important to kind of highlight, is that once you set up the fund, if for whatever reason you can use some of those funds within the opportunity zone fund to then acquire other properties, as long as it's within that 10-year timeline, does it do those newer properties, as long as that, and again, they have to still meet the requirements that are set out for the fund itself. So the substantial amount of income has to be coming from. Go ahead.
You got to do substantial improvement, or it's got to be original use.
Yeah.
So let's talk about that real fast. So original use means it's never been put in service. So you could find a developer. I actually had a conversation with a guy today. He's buying a condo in a ski lodge that's in an opportunity zone out in Utah, and he's closing on it before anybody moves in. And then he's going to turn it into an Airbnb. And so as long as he's buying that new ground up construction, bam, that hits original use. If you buy something that's got a building there, you have to double the basis of the value of the building. So if you buy a house for $250,000 and the house itself is worth $200,000, you got to put another $200,001 into it. But as long as you comply with that and you get that substantial improvement or original use done, it doesn't matter when you bought that asset. It's all about when you put your money into the fund. And so if you seed your fund with $1 million and then you grow those assets and you're able to bring in leverage in order to be able to go buy more, you could absolutely do that. And then you could buy a house 9 years from now. You put your money in today, 9 years from now, you buy a house, you hold it for a year. Now, bam, you're past your 10-year hold, you sell it, and it's tax-free.
Yeah. And that's even more powerful as well, because again, as operators of real estate businesses, we're constantly trying to find different ways to be able to, benefit from our activity. And so if you can utilize this structure to be able to operate within the field and then ultimately gain the benefits down at the end of the timeline, obviously that's an even added benefit to someone versus just setting up a fund for one project and kind of not necessarily setting it and forgetting it, but that it's only tied to that one entity, and that's all you can really benefit from. Now that again, you could potentially set up other funds, but I'm just saying if you could do it all through one entity and it benefits you the same way, obviously that's an additional benefit.
Correct. And we help people do those analytics all the time. All right, should I run it through my existing fund? Should I set up a new fund?
Sure.
And that's literally every Tuesday we're running those issues to ground.
That's amazing, man. Really,
Yeah.
I'm sure you're providing a lot of value to the environment. So we would definitely appreciate that. So, you kind of mentioned there's some legislation out there currently that likely probably won't get heard pre-election, but what do you see as the future of the OZ program? Do you see it kind of continuing in its current limbo state, or do you think in the future there's going to be some expansion to it? Because to your point, there's been $150 billion in projects, as you alluded to, that
That's
have
right.
been instantiated because of the program. So I just wanted to kind of give you the floor to kind of share your thoughts on the future of the program itself.
Yeah. So if we continue with the Biden administration has said that they are kind of agnostic on opportunity zones. They see the benefit, but they're not going to get behind it. And we've seen that in play, right? They haven't touched it. They haven't done anything against it. They haven't come out to really bolster it. But bicameral, bipartisan support in both the House and the Senate has said, listen, this program is amazing. We need we need to make sure that we extend it. And so we've seen lots of activity associated with that. And, we had legislation pending, but through just the machinations of Congress and, a divided Congress at that, it just hasn't gotten the legs that it needs in order to get out. I think that after the election that's going to happen no matter what the outcome is. And that's with a divided, House and Senate and presidency. We're going to see that happen, I think. Now, if Trump gets elected and, we see the Republicans take the Senate, then unequivocally, we're going to see some, we're going to see the legislation get significantly bolstered. And, I don't know. My prognosticator on elections, I got out of that business a long time ago. But either way, I think we're going to see an extension on the program. Even if we don't, that's why it's important for people to get their funds set up now, because they got till 2026, even if nothing happens on it. And then if something happens to extend it, it's just gravy, because now they've got their funds, they've got their tax-free vehicle, and it's the ultimate hedge on capital gains rates increasing, because you're setting it up to where you're not going to pay capital gains. And you have all the way until 2047 to utilize the program right now. And so there's a really big window. It's just, it's like, all right, how is, are we going to see that window get opened even more?
Yeah. And to your point, you're exactly right. So, if someone, obviously it's great if the program gets extended, and obviously it's going to benefit us for a much longer period of time. But to your exact point, if you're thinking about this being something that could potentially work for you, you should definitely look into creating a fund immediately and just being able to ride out that period of time, even if you don't have something identified at this current moment, because as long as that clock gets started, you could potentially benefit from that 10-year hold period, which is ultimately the greatest benefit of the opportunity zone based on the way that you've described it thus far. So
that's right.
Yeah,
that's exactly right. And what's funny is that, if you have a gain, or you have appreciated stuff where you could take a gain. So we've helped lots of people with a stock portfolio or a crypto portfolio, going ahead and harvesting some of those gains to start their fund. If you don't have a gain, but you have a project, we help people start their fund and loan money in anticipation of a gain down the road. And so, the key is that it's like, when was the best time it's an old Chinese proverb. When was the best time to plant a tree? 30 years ago. When's the second best time? Right now.
Yeah. 100%. And kind of to outline for those who are listening, I know we have a lot of brokers that are listening to this podcast, and oftentimes we advise our clients on the best strategy as far as disposition is concerned. Obviously, the tried and true method for many years has been the 1031 exchange, and I think it's a phenomenal vehicle to be able to kind of kick the can down the road as far as being able to not have to pay capital gains on the sale and ultimately the acquisition of the property. But the step up in basis piece in 1031 exchanges happens when you die. So it's not a optimal scenario,
And so this is something else that people aren't talking about. And I'm really glad you brought that up, because I am on a mission to educate people about this. If you are anywhere approaching a $10 million net worth, the step up in basis when you die is really bad, because you get the step up in basis and then your estate has to pay 40% on anything above $10 million within 180 days. And so if you've got $10 million worth of stuff inside of or let's say that you got $10 million worth of other assets, and then you got $5 million inside of a 1031, now all of a sudden you're like, Rorge, I got to pay 40% tax on $5 million in 180 days. And nobody's talking about that. And it's a real issue, and I mean, it's a great issue to have, right? If you got more than $10 million net worth, but if within the wealth transfer that's happening, we've got tons of baby boomers that they have this issue, and people aren't addressing it. And so if you can raise this issue as a broker, all of a sudden, wow, you're the smartest guy in the room at this point. And, and because most of those folks, financial advisors aren't talking to them about it. Their attorneys aren't talking to them about it. We're also going to give you a little tip on something else you need to be talking to your clients about that opens up the door for you to be able to have that telephone conversation with them in the form of the Corporate Transparency Act. And these things are what puts you to the front of the pack relative to distinguishing yourself. We help brokers, real estate agents, business brokers, registered investment advisors all day long to make themselves a designated expert on something like this. And we back them up. So we've got all of the stuff to help them, and we can help educate you to the point where you can talk about it, intelligently.
Absolutely. And to your point regarding our relationship with clients as a broker, we're kind of the quarterback of the transaction in most cases. So oftentimes we're responsible for coordinating with all the different parties to make sure that the transaction operates in a smooth as possible. And there's a lot of work done on the front end oftentimes when you're dealing with sellers to say, okay, how are we best going to be able to structure a deal so that it gets you to your final destination, whatever that may be, because everyone's desire is going to be different depending on their lifestyle and their circumstances and what their ultimate goal is long term. And so if you can come in as an advisor and say, hey, your options are an outright sale, your options are a 1031 exchange, you could look into UPREITs, or you can even consider the opportunity zone piece, especially if they're a business owner and they have other assets. So now you got the stock component that's in play. Now you have the actual operating business component that's in play. And if you have real estate, that's just a cherry on top. So, again, there's various different ways you could advise your clients such that you become an extension of their team. And you're essentially they'll call you up and ask you for advice and be like, hey, what do you think about this? Because you showcased your willingness and ability to be able to advise your client to the best of your ability. So just kind of reiterating for those who are hearing, and this is why I think this type of program could be very beneficial for a lot of people. And if you guys have an opportunity, I wouldn't hesitate to reach out to Ashley to learn more about it.
So the same dynamic that we've taken with opportunity zones, right? It was a fairly in the initial legislation wasn't complicated at all. The 500 pages of regs was. And so we took that, we distilled it down. We came up with an easy to understand and easy to execute process. And that's where we really, I think where we really shine. And we've taken that same, MO and we've applied it to the Corporate Transparency Act. So this thing came out like 2 years ago, but people just started talking about it this last year because it went into effect for new companies that start up after January 1st, 2024. They have to file with FinCEN. Any beneficial owner that owns more than 25% of the company, you have to get a driver's license and an address on a warm body to FinCEN within 30 days of setting up the entity. We've set up over 500 entities. We tried to figure out a way where we weren't going to have to deal with it, and there was no way. So we're like, you know what? We're going to bite the bullet. We're going to figure this thing out just like we did opportunity zones. So we partnered with a group that's got a portal, and that portal makes it extremely easy to be able to upload your information and to be able to then, and this is the key, is within FinCEN, if your personal information changes, so you get a new driver's license or a new passport, or you change your address, you have to notify FinCEN within 30 days for each company that you are a beneficial owner in. And you got to file that report. And so it's not that complicated if you got 2 or 3 companies. But if you're an owner in like 10 or 20, some people are owners in hundreds of companies, it becomes a logistical nightmare. That's where our portal comes in and where we have been helping people out with the Corporate Transparency Act. It's really relevant too, and this is where it comes in for your listeners and for brokers out there, is that every single entity out there will have to file with FinCEN if you don't meet one of the exemptions. And basically that exemption is that you do more than $5 million in revenue. If you don't hit that exemption, you've got to file by December 31st or January 1st of 2025. And there's approximately 32 million people that need to file, and like 2 have done so thus far. And so there's going to be a massive onslaught at the end of the year, and I guarantee you it's going to shut down. But that doesn't preclude your your need to have filed. And so we're trying to get people to be talking about this right now and trying to get them helped out so that they can get their stuff filed and they can get it done prior to that onrush at the end of the year.
Yeah, and kind of elaborating on the Corporate Transparency Act. I mean, my accountant won't even fill out the form for me. They just don't want to even take on the liability.
No.
So, yeah, and I get it. It's absolutely ridiculous in my opinion. But I digress.
I don't disagree. I can see the benefit relative to trying to cut off money laundering.
Yeah, 100%.
But I mean, like, I'm really nervous about what Uncle Sam's doing to protect all of that personal information that they've got sitting in one database that would, I mean, it's like a big target on it for hackers, right?
Oh, absolutely. No, that's another important point, is that you have access to all this information and again, very sensitive data that could potentially be.
Yeah, and I don't want to keep it. So that's why we have a portal with somebody that's got SOC 2 compliance, because your driver's license, your passport, if your accountant's taking that information from you, you better ask them what kind of security they got. And so we do that, and we make it so that it happens at a SOC 2 level compliance. It's like a vault. Anyhow, so we've got information. You asked about the Opportunity Zone cheat sheet. We've got that at a landing page specifically for your listeners. If you go to ozpros.com/Raphael, we've got a special pricing. If you want to get on a strategy call with us, we got special pricing for the Corporate Transparency Act, and it's got our Opportunity Zone cheat sheet and slides if you're interested in that.
Yeah, no, I appreciate that. And we'll make sure that's included in the show notes. So if you guys are listening to us in a podcast format, whether that's Apple Podcasts, Spotify, it'll be in the show notes or description. And then on YouTube as well, it'll be in the description as well. So you guys can reference. And all right. Well, I had one question for you before we kind of open up to Q&A for those of you guys who are listening. Is there a particular point or question that maybe I didn't ask you during this interaction that you wish I would have asked you that maybe is a pertinent point for the audience?
I think I kind of covered it, but a lot of people ask me, like, okay, how much money do I, how much capital gain do I need to make this worth it? And the answer is that you could literally start this with like $1 of capital gain. So it's not about your capital gain. It's about how much you anticipate making with whatever venture you're doing. And if you think that that's going to be a lot, man, it probably justifies trying to figure out if you can make it work inside of an opportunity zone, because it's not how much capital gain you have now, it's how much you're going to have in the future. And this is a way to eliminate that. So that's what I would say to people.
Definitely. And then another question I had, kind of ancillary as you were speaking, was related to, retroactive use of opportunity zone funds. So for example, let's say I just finished a project that is in an opportunity zone, or maybe I haven't broken ground yet. Maybe I'm working on a development and it hasn't broken ground yet. And maybe I haven't set up the fund in order to acquire the property, but I still want to potentially benefit from it. Is there an opportunity to be able to leverage the program, or have you kind of, lost out on the opportunity?
We can usually fix it. It depends on, so that's a great one. Do not buy opportunity zone property in your own individual name with the anticipation that you're going to quit claim it into an opportunity zone entity later on, because that makes it so that it's a bad asset. So if you've bought it in an LLC, regardless of what LLC or like any kind of entity, we can usually fix it after the fact.
That's awesome.
Yeah.
Great elaboration there. All right. So what we'll go ahead and do is we'll open it up to Q&A. So if you guys are listening to this on LinkedIn or various other social platforms, feel free to type away in the chat box. We'll give it about a minute for discussion, and we'll take it from there.
Raphael, this is a awesome setup. I love your program, and while we're kind of waiting on that, and love what you're doing. I think that, there's such a need for it inside of the space. I see it with real estate brokers. I see it with business brokers. and even to a lesser extent with registered investment advisors, there's just so much traffic out there that, listening to a podcast like yours, and kind of following you is a way to be able to, increase your education and to kind of rise to the top of the heap. So well done. Kudos.
Thanks, man. And to your point, you don't have to be an expert. Like I will probably never be an expert in understanding the various nuances of the program. Likely won't read the 500 pages of different regs that are available for people to be able to do. But knowing professionals like yourself who understand the nuances of the program is where we can definitely add value to the people that we work with. And even if you're an investor, for example, and you're a syndicator and you're raising money for deals, being able to provide some context and elaborate on this particular program so that you can raise money from investors and then they feel comfortable in understanding the program and how it potentially could benefit them is another value proposition you can offer. So
absolutely.
Again, I think that's, kind of reiterating the point of this discussion. I think that's why having you on the show, obviously we're honored to have you, and looking forward to continuing the dialogue in the future as well, especially as the program continues to evolve. So maybe we can do an update in,
sure,
the next 12 months
like
after the election.
if the legislation goes through, or depending on what happens with the election, that'd be exciting to kind of jump back in and say, hey man, this is the, and depending on the way the election shakes out, I mean, OZs were forefront in the news, right? In 2018, I mean, it was hot and it was the topic that everybody was talking about. There's one guy that he said, man, he's like, opportunity zones are like high school sex. Everybody's talking about it, but nobody's doing it. And, and since then people have, actually started doing transactions. I think it's dropped out, and there's this misconception that it went away in 2021. One benefit went away, which is actually kind of a rounding error when you look at it. So it's going to be exciting to see what happens when the legislation goes through and what happens after the election.
Definitely. Well, great. Well, Ashley, it looks like you've answered all the questions we have. We haven't gotten any questions as of yet, but really, thanks again so much for your time. We greatly appreciate everything that you've provided to us today. If people want to learn more about you, be able to get in touch if they're looking to set up their own fund, how would they be able to do that?
Yeah, so they can literally click the QR code that's on screen here. They can also go to ozpros.com/Raphael. And we've got a special promo for your listeners we have strategy calls. We've got that mastermind. We also have the setup, and then we've got the Corporate Transparency Act compliance stuff that we do as well. And we'd love to help your clients and your listeners, kind of rise to the top and be able to save money on taxes.
Definitely. Yeah. And we'll include all that information in the show notes, as well as Ashley's LinkedIn. I'll make sure you guys, if you have a chance, definitely connect with him on LinkedIn. And, if you have any questions in particular or would like to set up a strategy call, please do so. Well, we greatly appreciate everything that you've done. Obviously, thanks again so much for your time. If you guys are watching this on YouTube, please like and subscribe. It makes a big difference in our ability to reach a broader audience. So thanks again so much for tuning in, and we'll see you all next time.
Cheers.